What's up everyone, Adrian here, and once again it's time to unveil and review my entire passive income focused portfolio. So if you're new to the channel, welcome aboard guys. The mission of this channel is to help ordinary everyday working people to invest on their own in order to build their own stream of passive income to enhance their quality of life and eventually become financially independent. So the video thumbnail was not clickbait guys. The numbers are 100% real and I will show it to you in a second from A to Z. I get many comments and emails from you guys telling me that you really appreciate my complete openness and honesty about my portfolio and what I'm doing, something many investing gurus on YouTube don't do. So myself, on the other hand, I do it every single month. So if you're watching this video, make sure you're watching my latest portfolio update because I usually do an update every single month. This video is update number 7 for July 2021. So please keep hitting that like button and subscribing so you don't miss out on my future content and also on my community posts and surveys. I do a survey every single month so you guys, the viewers, can decide what topic I cover next, and all you need to do in order to be able to vote is to be subscribed. So if you're not subscribed yet, you know what to do. So just a quick summary of my investing strategy and a few important reminders before I unveil everything. Please listen to this part if you're newer to the channel, as I will cover many of the frequently asked questions or FAQs that I keep getting all the time. So this should answer most of them. First of all, I am Canadian, so most of the funds and stocks that I in my portfolio that I'm about to show you are listed on the Canadian stock market, on the TSX, Toronto Stock Exchange. So the number one question I get from Americans or even people outside of North America is that they cannot find these ticker symbols, the stock symbols. So I repeat, these are Canadian listed, or most of them are Canadian listed funds. So not all brokers outside of Canada can access these funds. So if you're American, I would not invest in these Canadian listed funds. Not only are there additional taxes that you need to pay, but you guys have the best stock market in the world, the NASDAQ, the New York Stock Exchange. So it does not make sense to me for Americans to invest in a foreign stock market. My income focused strategy, which I will explain in a quick second, can easily be replicated with funds on the US stock market. I have a YouTube playlist that has all my videos where I cover specifically the US listed funds. So make sure to check out that playlist if you're American. Also, I do offer a digital product on my website, passiveincomeinvesting.ca, for only $45 Canadian, which includes all my years of research, the best funds designed for income in Canada and the US as well. And it also includes sample portfolio for Americans and Canadians. So I strongly suggest you pick it up if you really like my investing style. Now, a quick note about my investing style. Now, I am a long-term buy and hold income focused or income seeking investor. So the primary objective of this strategy is to generate high and consistent passive income via dividends and distributions every single month. So most, if not all, my returns do not come from capital appreciation or stock price increase. It comes from the income, the consistent income. So I know this is a hard concept for people to understand because all you ever see and read in the media is mostly on growth stocks or stock price appreciation, right? Buy low, sell high later. There is another way to make money with the stock market where you don't care as much about stock prices, my way. So this means that my main portfolio primarily holds funds that invest in blue chip corporations and that use income enhancing strategies like covered calls or leverage. So they provide consistent income, and the intent is really to hold them, not trade them or sell them later for a profit, and simply collect the passive income forever. So the strategy has enabled my wife and I to become financially independent or financially free in our mid-30s back in 2019. You can check out my financial freedom journey video if you want to see our whole journey. It's an older video, but the info is still valid. So my strategy might not be fun, exciting, or mainstream, but I could promise you that it works. You just need to stay focused and disciplined. Slow and steady wins the rat race. Also keep in mind that I am not against the more mainstream growth strategy where you just buy the popular big index funds from Vanguard or iShares, and I am not against the other popular strategy, which is the dividend growth strategy, where you either hold single dividend stocks or dividend themed ETFs. So this is just the strategy that works best for me. So 4 quick reminders. This is my main portfolio and is made up of a combination of 4 investing accounts. My TFSA, tax-free savings account, and regular cash account or non-registered account, and my wife's TFSA and her regular cash account. So the income it generates, these 4 accounts generate, is what we use to pay all our living expenses. So the dividends are extracted every month and go straight to our bank account, which means we don't use the drip for these accounts. Number 2, the portfolio, this main portfolio that I'm about to show you, does not include our RRSP accounts, our retirement accounts. Those are completely separate, and I have another video covering our 2 retirement accounts in detail. So if you're interested to know what we hold in those, make sure to check it out. The reason I keep them separate is simply because of how the retirement accounts work. As you know, they are retirement accounts, and you should not withdraw any of the money until you turn it into a RIF or an annuity much later on for retirement. So the dividends and distributions in those accounts are compounding every single month. Number 3, I will quickly show you my 4 accounts directly in my broker. So you can actually see how my principal or my capital is doing, even though it's definitely not my biggest concern as an income-focused investor. And then I will show you my portfolio spreadsheet all in an Excel file, which is a combination of those 4 accounts. I will go through each fund one by one that I own, tell you about any changes I made from last month, etc., etc. And finally, you could download the spreadsheet that I'm about to show you for free on my website, passiveincomeinvesting.ca. You just need to click on the free tools and resources button at the top menu, and it will be the very first download. Then just click on the red download button to download the Excel if you want to follow along, or if you just want a copy of my portfolio for a reference. So without further ado, let's check out my entire portfolio together. All right, guys, so let's go through the 4 accounts on my broker. I do use TD as a broker. So the real reason I'm showing you this is, 1, so you could actually see how my capital or my principal is doing. I get many criticisms saying that my strategy, the capital will never grow, it will be stagnant. So that's simply not true. That's reason number 1. And number 2, so you actually believe me. So you actually believe the Excel file that I'm going to show you. So this is my cash account. And as you could see, I am up 75K on it, or up 29%. So it is in order of my losses to my gains. So most of everything is pretty much doing really, really, really well, just like the stock market in general, guys. I mean, it's not a surprise. So just to prove to you that I'm doing this live, it is Friday, July 9th. The stock market is still open. Look at this number here, 75,811. I'm going to refresh it, and you'll see that it will change. 863. So there you go, just to prove that it's live, because the stock market is still open. So this is my cash account. Now let me show you my TFSA account. Here's my TFSA account, guys. This one is only up 1% overall, mostly because it does have a lot of financial 15, which did a reverse split. But besides that, pretty much everything is pretty much in the green here. So this is my TFSA account, which is completely maxed out. You could see here, the account limit is 75.5 right now, so it is completely maxed out. So now I'll show you real quick my wife's accounts. So here is Erica's cash account or non-registered account. This one is also doing well. It's up 18% or 51K. And as you can see, most of the losses that I actually have are from my very little or very few speculative positions that I have. So I do have $2,000 in a Bitcoin ETF, which I just did for fun. It won't be included in my main passive income portfolio, but I'll show you everything because I want to show you guys everything here. And I also have 5,000 in a leveraged cannabis index ETF, HMJU. So as you could see, that's where I'm pretty much down on here. 38% on the Bitcoin ETF, only 9% on HMJU. But that's what you get when you speculate, guys. This is why I don't do much speculating. I only invest for income. And as you go down the list, as you could see, the green just keeps growing and growing and growing, because all these funds are basically all in the green. So now I'll quickly show you her TFSA before I show you everything in the Excel file. Here is Erica's TFSA account, also maxed out. And as you can see, it is doing pretty good, up 29%, much better than mine. And this TFSA actually holds some of the highest yielding funds that we have. So I get a lot of questions about, what to put in a TFSA versus a cash account. I like to put the higher yielding funds in the TFSA account because it helps to increase my contribution room for next year. Keep in mind, I extract the dividends every month, right? So whatever you extract can grow your contribution room for next year. So it's a good trick to have as an income investor, a good trick to understand. So here's a TFSA account. So all in the green. And now let's review the whole thing. All right, guys, here is my Excel file, which is basically the combination of all 4 accounts. It's separated in sections: income funds or closed-end funds first, then ETFs, split share funds. Then I got some single REITs and single stocks, which I won't discuss much on because they don't make up a big portion of my portfolio anymore. So obviously here, this column is the name of the fund, the stock name. It's got the stock symbol here, the stock details. So this is just, my take on, I usually try to say what sector the fund focuses on and regions, sector and region. So this is my investment, or how much money I put in to this fund myself. So my principal. The weight is how much, overall, the percentage, how much it makes up of my portfolio, the number of shares that I have. This is my book price. So this is the price I got the shares at. So my average share price. Okay, this is the yield, and the yield is not based on the current share price. It's based on my share price, on my average share price or book price. So Canoe EIT, for example, right now it is not yielding 11.95. It is yielding about 10% because it's the stock price is higher than $10.04. It's about $12. So just I want to make that clear that this yield is based on my book price. The annual dividend, so this is the annual dividend rate, right, per share. And of course, my annual income and the monthly income that the corresponding fund provides. So let's go through the income funds. I did make one change this month. So as you could see, I went from 6 to 5. So let's go through them one by one. Number 1 is EIT, the Canoe Financial EIT Income Fund. My OG, my favorite closed-end fund of all time in Canada. It is Canadian listed. It's mixed sectors. It's a really nice diversified fund. It has both North American, so it has, both Canadian and American dividend growth stocks. And I did read the prospectus recently and did find out that this fund can actually write covered calls or puts to increase the income. And that's why I added a little star here this month. So this, anything with a star means it can use or it uses the covered call income enhancing strategy. So if ever you're interested in this fund, I have a video specifically on the EIT income fund, which I strongly suggest you check it out. As you can see, it's one of my biggest holdings at 40,000, so it makes up 5.83% of my portfolio. So obviously, I really like this one. Now, I used to have BGI.UN, an income fund from Brookfield. I did sell it this month, and the reason I sold it is because number one, the biggest reason is not because I don't like it. I think it's a great fund, but it was in my TFSA account. So I was up $3,000 on it, and I sold it because that $3,000 capital gain is completely tax-free. So I sold it and I distributed that income to 3 other things, and you have it here. So I bought more ENS, which is the Enbridge Split Share Fund, PWI, which is the new infrastructure and utilities split fund from Brompton, and Innovalis, a single REIT. So I'll talk a little bit about more of these when I go through them in the list, but that's basically what I swapped out BGI.UN for. Next one is my 2 favorite funds from Quadravest, or 2 of my favorite funds from Quadravest. It's the Dividend Select 15 Corporation. So DS, this is a collection of the best Canadian dividend stocks. So there's 15 Canadian dividend stocks in here, and it's really a twin brother of Dividend 15, which is a split share fund by the same company, Quadravest, and I'll review that in a second. So this one has, just like the next one, Income Financial Trust, Inc.UN, also from Quadravest. The only difference between Inc.UN and DS is Inc.UN only holds financials in Canada and the US. DS holds mixed sectors only in Canada. So what's really unique about these two really, really cool, is the dividend policy. I keep talking about it every month, but I just have to because I love it. And it's very, I need you guys to understand how these two funds work. The dividend policy, so the monthly dividend changes every single month based on the stock price. It's 10% of the stock price. So whatever the stock price is, take 10% of that. That will be the annual dividend rate. Divide that by 12 and you have your monthly dividend. So essentially, in short, guys, the higher the stock price goes, the higher the dividend goes, or the dividend rate goes, which means that your yield will go up. So as you can see, I have an enormous, monstrous yield for DS now because my book price is $6.42, but the share price is over $8. So if the share price is around $8, 10% of that is 81 cents. As you can see, that's the dividend here, and it increases the yield every time. So let's say it goes to $9 and it changes to 90 cents. Well, my yield jumps to 14. So as you could see here, whenever the share price goes up, the dividend goes up as well. And Inc.UN is especially crazy because my book price was $7.57. Now the stock is over $16. So the annual dividend rate is 10% of that. So I could actually change it to $1.60 if I wanted to. And you see my yield just keeps going up. So I have an absolutely ridiculous yield on Inc.UN right now at 21%, which is absolutely phenomenal. Next one is CLM. This is the Cornerstone Strategic Value Fund. This is one of the only three US listed funds that I have in my portfolio. So I do have to pay a 15% withholding tax on the monthly dividends that CLM gives me. But even with that, because this fund is so great, it's so high yielding, I'm still nabbing a yield of 13.43%. So this includes the 15% withholding tax. Or normally it would be about 15 or 16%. And CLM, this guy has a very unique dividend or distribution policy as well. It's basically reset every single year in January, and it's reset to 21% of the NAV. So whatever the NAV is, like DS and Inc.UN, it's based on stock price. Well, this is based on NAV price, net asset value. So whatever the stock is worth, not what it's trading for. So right now, the NAV is actually a lot higher than the current dividend. So if we could look at it real quick, I think it's about 1050 last I checked. Yeah, 1050. So if the NAV stays the same by the end of the year, if we do 1049 plus 21%, it's $2.20. So the 192 dividend will become 220, and my yield will go from 1343 to 1536. So absolutely phenomenal, guys. This is how basically funds that have changing dividend rates, this is how they work. So if they go up, your yield will go up. If they go down, your yield will go down. Simply how it is. So last but not least, the last closed-end fund I have is FAP. This is the Aberdeen Asia Pacific Income Investment Company. So this is one of the only funds that I have that really is specific for fixed income. So it has Asia Pacific bonds. So bonds, government bonds, corporate bonds in the Asia Pacific region. So we're talking about Thailand, Indonesia, Australia, Japan, those countries there. So the real reason I added it is, number one, it's trading at a big premium right now. So the NAV is a lot higher than the stock price. I also like the yield. It's a little over 9%, which is great, but it's really to add some spice, some diversity to my portfolio, which is really heavily based more on blue chip stocks in North America. So this is literally just to add a little bit of diversification, which I'm a big fan of. So only 10K here, 1.46. So those are my closed-end funds. Let's check out the ETFs now. All right, ETFs, guys, my bread and butter. This is the bread and butter of my portfolio. I'll show you all the percentages, by the way, all the final numbers or the overview numbers at the end. So let's go through the ETFs one by one. At first, you have the BMO ETFs. I have six of them. I absolutely love the BMO covered call ETF. So you have ZWC, which focuses on dividend stocks in Canada, ZWE, dividend stocks in Europe, ZWG, global dividend stocks, primarily in the US, however. So these three is what I like to call the Triforce. This is really for me, in my opinion, conservative dividend investing. You have big blue chip dividend stocks with covered call income. So they're all averaging a little around high 6, low 7s right now in terms of yield. Obviously, I have a little bit higher yield because my book price is a little bit more lower than the current price. So I've been getting some comments and emails because recently ZWC, ZWE have both lowered their monthly dividend from 11 cents to 10 cents. And I have a lot of people that are asking me, what do you think? Why? What happened? The honest truth is, if you actually look at all the BMO ETFs, look at their distribution history, you will see that there are some minor glitches and hiccups where the dividend goes down for a month or two, then it goes back to normal. So I'm not putting my money on that it's a permanent distribution decrease, guys. So this is why I left the annual incomes at $1.32, which is 11 cents a month, instead of $1.20, which is 10 cents a month. Now, will it always be 10 cents a month going forward? I don't know. Personally, I don't think so. So this is why I'm leaving it here. We'll just have to wait and find out. The only way that I would officially say that the new dividend is 10 cents a month for these two guys is if it's done, or if the next 6 dividends at least are at 10 cents. So we'll have to wait and see, but I'm not going to panic about it, guys. I'm not going to just sell them just because of that. It's a very minor reduction anyway. ZWG holding strong. So this is really a collection, like I said, of the global dividend stocks that has Europe, Canada, Japan, mostly Australia as well, mostly US though. That's simply because that's where the best dividend companies in the world are. ZWK is where I get my specific US financials bank exposure. So this has the top US banks in America. So really high yield. I was lucky enough to pick some up mostly during the crash. Right now the fund is like $30 a share, and the yield is about a little under 8%, so or 7% rather. So I'm lucky I got it at 10% yield here. ZWU, this is one of my favorite ones. This is pure defense, guys. It's utilities and telecom companies in North America. So I have a nice chunk in here, 15,000. Very defensive, very stable. ZPH is the last one from BMO. This is this uses a put option strategy. So this is a great place to actually park your money. This is what I like to call a really safe ETF. It's safe because it doesn't hold anything, and I will make a video, I promise. I know I keep saying it, on the ETFs that I find are the safest really for conservative investors or income investors. So this is definitely at the top of the list for me. So this is, I kind of consider this my cash savings account. So instead of putting money in a cash savings account at the bank making less than 1%, I'll put it here because it's very stable, and I'll make over 7% yield on it. So really good way to park money in my opinion. Next 4 are from CI First Asset, some of my favorite covered call ETFs, which have really high yield. So CI First Asset, unlike BMO, who primarily focuses on region-based covered call ETFs, CI First Asset focuses on sector-based covered call ETFs. So they tend to have higher yields. The only thing is that the dividend is quarterly instead of monthly, and it varies every single month. That's why you have they're highlighted in blue here. So these dividend amounts are the combination of the last 4 quarterly dividend payments. So you could say the average for the last year. So FLI holds just financial stocks, but what I like about it, what's special about it, is it's only life insurance companies. So financial ETFs tend to have mostly just the banks. So this one is just the life insurance companies, and only the best, the 10 biggest ones in North America. So Sun Life, Manulife, Great West Life in Canada. Then you have MetLife, Prudential, Lincoln, and a bunch of other ones in the US. So really cool fund, really high yield as well. It's yielding about 8% right now. NXF, this is where I get my specific energy exposure. I'm not a big energy guy, but this is definitely my favorite or my go-to energy ETF. So it holds 15 of the biggest global oil and gas producers out there, and that's literally why it says energy giants. So these ETFs, by the way, they only have the big boys, so hence the name, energy giants, gold plus giants, tech giants. So we're talking about Canadian Natural, Suncor, BP, Eni, SPA, really the big ones all around the world, Chevron, all those companies. So 15 of the biggest oil and gas producers out there. CGXF is where I get my gold and precious metal giant exposure. So this is for the gold miners and the gold producers. It was actually a pick of the month for July because, as we all know, gold miners, precious metal miners tend to lag when the stock market does really well. So I actually invested $5,000 in this one. this month. Let me just go back to my fund tracker. Yeah, okay, so I invested in it at the end of June, technically. So I did add a little bit more here. This is the I have 20K in here opposed to 15 like the rest of them. So really, Barrick Gold, only the big guys here, Newmont, Wheaton, Yamana Gold. So really only the big guys, no junior miners in here or producers. TXF is for technology. So this has the 25 biggest technology companies in the world: Apple, Microsoft, Qualcomm, Nvidia, AMD, Zoom, Amazon is even in there, I believe. So anything to do with technology, this is my go-to ETF. You get this ETF, you have the best exposure to the best technology companies, and you have a really, really high yield thanks to those covered calls. An absolutely monstrous 12% yield. You'd let me know if you could find a better yield with technology funds. Impossible you'll find something better than 12%. I actually think it's 12% still right now, 10 to 12%. So they get these really high yields, guys, because they have a very cool and unique covered call strategy. I'm talking about CI First Asset here. They write covered calls on 25% of the portfolio, which is, it's less than the average. The average BMO does 50%. Harvest does 33%, for example. The key difference is that their covered calls are very aggressive. They're at the money covered call options. So you get a lot of, you capture a lot of that upside, 75%, but you also get a lot of income as well. So really, really good covered call strategy, in my opinion, for sector-specific ETFs. Obviously, it works really, really well. The next two are from Harvest, another one of my favorite covered call income fund managers. So the first one is the best one in their lineup by far, HHL. This is where I get my healthcare exposure. So it's the Harvest Healthcare Leaders Income Fund. You have the 20 biggest healthcare companies in the world, mostly in the US, because that's where they are. So we're talking about AstraZeneca, Novartis, Johnson & Johnson, Bristol Myers, Pfizer, pretty much all the best ones, and also medical equipment as well. You got Abbott, you got Boston Scientific. There's a bunch of them. I don't know them all by heart, but keep in mind that this is really a one-stop shop for me in terms of healthcare. I love healthcare. It's an essential service. It's a defensive sector, which is why I have a nice chunk in here, 25,000. And also the yield is incredible for this one. It has been over 8% for a really, really long time. HUTL, is like ZWU, also focuses on utilities and telecom. The main difference is that it focuses on the whole globe. So these are global utilities and telecom companies instead of just the ones in North America. So if you could, like I always mention, combine these two guys, ZWU, and HUTL, and you're sure to have the best utilities and telecom companies in the world and making great income while every single month while you wait because of those covered calls, right? IDR, this is a ETF that focuses on real estate, mostly in North America. So it's managed by my favorite real estate expert, Middlefield. Middlefield also has a real estate split share fund, which I have a lot more money in. This one, I only have 10,000. And as you can see, there's no star here because it's one of the only ETFs in my ETFs here that doesn't use a cover call strategy. So this is a pure organic, I would say, not an income ETF, not a growth ETF, right in the middle. It's balanced because it doesn't use cover calls. So, really, really cool way to get exposure in real estate in North America, but I do prefer the split share fund, which we'll go over in a second. The next two are my other two US listed funds besides CLM. It's two of my favorite funds of all time on the US stock market, QYLD, of course, and RYLD. So QYLD is by far the most popular and the biggest income enhancing ETF on the US stock market. It's the NASDAQ 100. So it's like buying the whole NASDAQ, and it has aggressive at the money covered calls on it. So it has a massive income. These two usually, they tend to yield 10 to 12% all the time, which is absolutely phenomenal. But I got to pay 15% withholding tax because they're US listed and they are in my cash account. So, but even with the 15%, look at these yields, 9.75, 10.61, absolutely phenomenal. RYLD is based on a lesser known index, the Russell 2000 index. I really, really love this index. I think it should be in everyone's portfolio because the Russell 2000 index measures the smaller to medium sized companies in the US. So I like to think of this as the heart of America, small, medium sized businesses. So This is like buying a piece of the 2000 companies. So it's really, really good, really, really safe. And because the smaller companies have a little bit more volatility. Volatility helps covered call income, which is why it's actually beating the QYLD right now in terms of yield. HMMJ, this is the only speculative ETF that I actually included in my main passive income portfolio. The only reason is because it actually provides a small quarterly dividend. It's really, really small at 1.93%. But keep in mind, this is not income. This is not designed for income. It's designed for speculative growth, right, in the cannabis sector. So now let's check out the split share funds next. All right, so everyone's favorite, right? The split share funds, guys. This is where I get a lot of my income. These types of funds, split share funds, are really designed for high income because they not only use covered call strategy, but they also use leverage. So they use my two favorite income enhancing strategies. They use both of them. So the first one is DFN. This is the flagship split share fund by Quadravest. So like we saw before, right, they also manage Inc.UN and DS. So DFN actually has the same exact stocks as DS. The only difference is it uses leverage, so the yield is much higher. So it's at about 14% yield now. I'm at 15.36 because my book price is a little bit lower than the current price. And what I really like about DFN is the amazing dividend history that it has. So it's been around since April 2004, and it's only missed 4 dividends out of over 200 of them. So 4 out of 204. This is it's not updated. It's from April, so now it should be 4 out of 207 or something like that, 208. So the only 4 dividends that it ever missed was because of the COVID-19 stock market crash in 2020. You actually see them there. So a really, really good a dividend or distribution history. And keep in mind, guys, the distributions or the annual dividend rates are set in stone for the split share funds. Either you get it or you don't. If the NAV, the net asset value, the unit NAV is over $15, you will get the dividend. So this one only missed 4. The next one is Financial 15, also probably the second biggest one from Quadravest. Like the name says, it focuses on financials. I like that it has 10 Canadian and 5 US. So there's a bit of diversification. It's not just Canadian here. This one, I did add a little bit, but 25K is really my cap for now. And it did do a reverse split back in December 2020, 0.4 for 1. So I basically lost 60% of my shares, and that's really why my yield is a lot lower than the other ones. But hey, still a 10.79% yield with after that reverse split. I'm not going to complain, guys. This one, they did miss more distributions than Dividend 15. They missed 34 out of 207, but still not a bad record. And now, because of the reverse split, it's a much, much safer split fund than it was. It's actually much safer than DFN because the unit NAV is way over $20. It's at $21.50 last I checked, and where DFN, it's about $17.50. So the closer it is to the $15, the more at risk you are of missing dividends if there's a big stock market crash or correction. The next 4 are from Brompton, probably one of my favorites, split share fund providers. This is their expertise, guys. So LBS purely focuses on financials. It has the big 6 Canadian banks, the big 4 life insurance companies, really, really high yield, really, really good. My yield is 16.93, absolutely incredible. But right now the current yield is about 12%. So this one has a pretty good track record for distributions as well. They missed 18 out of 173, and 8 of which have been during the 2020 stock market crash. So you could see that I personally have missed 8 distributions all last year. I actually listed them here. So every single distribution that I missed, by the way, I put them in the comment, and that's why these are orange. So the ones that are in green, I have personally never missed any distributions. SBC is also financials, but unlike LBS, where it has the 6 banks and the 4 life goes, this only has the big 6 Canadian banks. So this is my go-to place to invest in the big 6 Canadian banks. Probably one of the safest split share funds ever. And you could clearly see that by the distribution history. It only missed 4 out of 184 distributions. And those 4 were actually back in 2008, 2009, during the 2008 financial crisis. So absolutely incredible, because SBC did not miss any distributions during the COVID-19 stock market crash. And that says a lot That's why it's in green, because I have not missed a distribution ever on this one. GDV, if you would ask me, what is your favorite? If you could invest only in one split share fund, which one would it be? I would have to say GDV. So this is a genius split share fund by Brompton, because it's one of the only split share funds that's super diverse. Not only is it diverse in sector, it's in diverse by region as well. So it's absolutely incredible. I have 25K here, and this is one where I would definitely add another 5 sometime soon. And this has, although it's a newer fund, it was started in June 2018, it has never missed a distribution. And I think it's really because of that diversification. DGS, this is basically the equivalent to DFN, I would say. So it's Brompton's equivalent to DFN. So it focuses on pure Canadian dividend stocks. The only difference between DFN and DGS is that DGS has a lot more variety. It has a lot more stocks. So it's a little bit more diversified, but the unit NAV is lower. So this is by far the highest risk, highest reward split share fund that I own. That's why I only have 5K in here. I'm not going to go nuts with this one. I don't suggest you guys do either, but it does provide obviously a nice income boost or yield boost to any portfolio. I mean, I got it at 541. I think now it's at $7. And look at this yield, 22.18%. Definitely the biggest yield in my portfolio. PWI, this is a brand new split share fund from Brompton, and as usual, Brompton is very innovative and very smart with their funds. So this is the first ESG split share fund. So it focuses on sustainable power and infrastructure stocks, just like the name says. So pretty much a lot on green energy, utilities, and also companies that are basically planning for the future, are going to have they have a lot of revenues that are coming from future technology and lithium and things like that. So Volvo, for example, is in there. Volkswagen is in there. Just give you an example, some car companies, as well as a lot of green energy companies. So really, really awesome fun. And I might have a little surprise coming up, a video specifically for this fund, but I don't want to spoil it for you. Stay tuned, because I do want to make sure to cover this one in detail. The next two are from Middlefield. Like I said, my favorite real estate expert. The first one is ENS. This is where I get my Enbridge exposure, guys. So Enbridge is the king of kings in Canada when it comes to consistent and growing dividends. This is an amazing way for income hungry investors to get access to Enbridge. It's basically all it holds is Enbridge shares, but it uses leverage. So instead of getting a 7 or 6 or 7% yield, you're getting a much bigger yield, 10 or 11% now. So I absolutely love this split fund. I think it's a really unique idea, and it's also the first split fund I've ever seen in my life that's actually raised the dividend. So the dividend was $1.20 when it first started, and now it's at $1.56. And they say they were able to raise it because Enbridge keeps raising their dividend. So no monthly misses. Another split share fund, which I consider very, very safe, just like SBC. RS is my new go-to, guys, when it comes to real estate, to invest in real estate. This is the first and only split share fund that is based that only has real estate exposure. So absolutely amazing. This has the best real estate companies in North America, or the best REITs. We're talking about Smart Centers, RioCan, Choice, and a lot of industrial real estate companies as well, which focuses on e-commerce. So I have a video just on this fund, guys, just on RS. I strongly suggest you check it out. I dive into this fund in detail, but definitely, as you could see from the investment, this is like Canoe EIT, also 40,000, a big portion of my portfolio. This is where I get my real estate, or most of my real estate exposure. Absolutely phenomenal. It's been growing really well. I have it at 1468. I think it's over 17 now. So the yield is a little low now. It's under 7. But this is probably, I'm not going to say probably, this is definitely the safest split share fund in my portfolio, because the unit NAV is something like $27, something crazy like that, way past the $15 minimum. So there are my split share funds, guys. Let's check out the rest now real quick. All right, guys, so the rest of my portfolio are my single stocks and single REITs. I still have some of them. I'm not planning on selling any of them, but they do make up about 20% of my portfolio together, the single REITs and single stocks. So I'm not going to go through them one by one, but these are basically the single REITs that I've decided to keep, and the single stocks I decided to keep. So I'm doing absolutely phenomenally well on all of them. They've all are up in my portfolio, and basically I decided to keep them because I don't want to trigger any capital gains and because of the yield. So these are really the higher yielding REITs on the Toronto Stock Exchange here, and these are some of my favorite single stocks that I've kept. I only have 5, and altogether they only make up $50,000 out of my almost $700,000 portfolio now. My 2 favorite ones definitely being Diversified Royalty and Bridgemark Real Estate Services. I did add 2,400 to Bridgemark this last week, just because of my OCD. I need to have it nice and even here. That's basically it. But all 5 single stocks that I have here are basically royalty plays. So this is why I'm really keeping them, because they are specifically designed for income investors, to provide investors with consistent dividends all the time. So this is why I've kept them, and I'm doing absolutely phenomenal on them. But I would have to go back a couple of years ago and redo everything all over again, guys, I would not be investing in any single REITs or any single stocks. That's just the truth. And the reason why is simple: you don't have to. There's plenty of funds out there that you don't need any more exposure to single stocks and single REITs. But either way, I just want to show you everything for full disclosure. And also new this month, I also want to show you my speculative growth positions that I have. I keep forgetting to tell you, I do mention HMJU and Bitcoin every time, but I actually keep forgetting that I have a speculative position in one cannabis company, Canopy Growth. I have 1,000 shares, and this is from like 4 years ago. So I only invested $63.25 in it at $6.33 a share approximately. And right now the company, the stock price is 27 or 28. So I'm going you could see here the book price. I'm going all in on this company, which means I'm going to wait until it really, really grows before I sell it. But I do plan it on selling Canopy Growth eventually. I'm up significantly on it, unlike HMJU and the Bitcoin. But so these are my speculative positions. Only 13,000 total, and a very, very, very small percent of my overall portfolio. I actually don't include this 13,000 in my overall portfolio. For me, this is completely separate because none of these 3 funds or ETFs or stocks, whatever, provide any income. But full disclosure, I know you guys like that, so here it is. So now let's check out my total numbers for my entire portfolio. So here are my grand totals, guys. So my total investment, or my principal, how much money I put in, not how much my portfolio is worth. It's actually worth it's worth maybe almost 800,000 now if I calculate the capital gains, but this is only how much money I put in. My principal, 687, 847. My average annual dividend yield, or think of it like an interest rate, absolutely incredible, 10.55%. So my average monthly income right now is $6,049 every single month of passive income. So total dividends that I've gotten lifetime, I'm just about to crack the $100,000 mark. I actually didn't update it for July yet, so it's definitely over 100,000 now. And I've made back with dividends 14.52% of my original investment. So this will keep going up every single month as I get my dividends, but it is offset or lowered when I invest more money, right? So stock type breakdown, you could actually see the breakdown of my entire portfolio. 15% income funds or closed-end funds, 33.95% ETFs. This is my bread and butter. I do expect this number to keep increasing. This is where I will focus my investments in the next couple of months for the rest of the year. Split share funds, a nice chunk in there, 30%. For me, it's okay. I'm okay with 30%. I don't want to go higher. I definitely would like my ETFs to be higher and my split share funds lower. So I will definitely be taking a little break from split funds this year and going more into ETFs. And then, of course, you have single REITs and single stocks, which together make up 20% of my portfolio. So all in all, guys, for 2021 so far, I've made $32,359 in dividends alone. And I also have some capital gains because I've made some moves. I sold some things at a profit and invested in other things. But normally I'm not expecting to sell anything much else in the future. So I know that last year I did have a pretty big capital loss because of I went from 125 stocks to now I have about 41 funds. So I did take some losses along the way. But the good news is that these losses, guys, make no difference to me whatsoever because I've already offset them completely. They're already gone because I've offset them going back to my capital gains of 2019. 2018 and 2017. So if you don't know this, when you have capital losses, guys, can be carried forward indefinitely. So you could offset your future capital gains, just like this $6,200 here, well, except for the portion in the TFSA, of course, with your capital losses. Also, you could carry back capital losses to offset capital gains by 3 years, up to 3 years. So that's why I basically offset the entire $34,000 loss, because this year when I did my taxes, I offset this to $6,000, I offset this $10,000, and I offset this $23,668, because you could go back 3 years. I can't go further than 3 years. I would have loved to offset the 2016, but I couldn't because there's a statute of limitations going back. But going forward, you could carry forward losses indefinitely. That's why this number here, although it might bother some people, it just makes me laugh. It doesn't bother me at all because it might as well be zero because I've already used up the losses anyway. So there is my portfolio, guys, in black and white. As usual, every single month I will keep showing you every single month so you could follow my journey. Hopefully this gives you the motivation to invest in these types of funds yourself. There you have it, guys, my entire portfolio in black and white. As you could see, especially if you're a long-time viewer or follower of this channel, I own what I preach. I wouldn't feel comfortable suggesting a stock or fund like my stock picks of the month picks without owning it myself, right? So keep in mind, guys, once again, this is a pure income focused portfolio designed for high income, not capital appreciation. Not to say that you won't get any like I showed you, but it's a strategy and style that fits my personality and our needs, and we love it. I mean, this is what got us financially free in the first place. I am not against the more mainstream growth style of investing. The important thing is that you invest, guys. So if ever you want to know more about my investing style and my philosophy, check out my other videos I have on this subject. I even have a playlist. Check out my playlist, guys, because I have a lot of videos, playlists set up for you guys on different topics like taxes, my investing style and strategy explained, philosophy explained, covered call ETFs explained, split funds explained. So make sure you check out my playlist, guys, because they're very, very well organized there. So as always, please support me, guys. Please support this channel by hitting that like button. I would really appreciate it. It's free for you, helps the channel grow, so it's a win-win. I know I've been growing a lot in the last week. I think we've got, in the last 28 days, 6,000 new subscribers. So I'm extremely grateful for you guys, to you guys. I really hope these videos help, and I absolutely love making them and showing you everything. So I will continue to do so. I will continue being an open book about my portfolio and my situation. Make sure you visit our website, guys, passiveincomeinvesting.ca. That's where you can access my digital product, the Ultimate Dividend Passive Income Investing Package, which is all my years of research into spreadsheets. It includes sample portfolios for Canadians and Americans, and it comes with lifetime updates. So it's on version 2. So if you buy it now, you won't have to worry, you'll get the next versions for free. And I'm actually working on version 3.0 right now. On my website, you could also book a one-on-one live video consultation with me personally. If ever you want my help, you want me to review your portfolio, build a new portfolio, modify one, ask me a million questions. I love providing this consultation service. I know that right now I'm fully booked, but appointments will open up soon for August. So stay tuned. I'll make a quick video and let you guys know when that's the case, when August opens up. So finally, guys, make sure you're subscribed. You don't want to miss out on my future content and community posts on passive income investing. It's all designed to help you guys out on your investing journey. Let's take this journey together. There's plenty of dividends for all of us. We're on social media as well. We have Instagram, we're on Facebook. We have a Facebook group that keeps growing, so make sure you join our community there. We're at 17 or 1800 members now. Absolutely incredible. I see the questions and the back and forth with everyone. It's really, really cool, and it really gives me myself confidence because I never knew so many other people are into these types of funds. And now that I see people talking about them, it gives me the confidence knowing, okay, I'm not the only one making this easy passive income. My goal is really to share this with the world, because it's the easiest way for everyday people to make money. So with that, take care, guys, stay safe, and see you next time.